Hey everybody, this week you have to do chapters 8 and chapters 9. Let's go ahead and look at chapter 8 for Kate's cards. So Kate has decided to document her operations. And when she did all that work, what she did was she realized that, hey, she has a potential course she can sell here. So she's documented everything she does. She even has a video that she's created. And she says, well, it takes me about $4,500 to make one of these courses. She plans to mark it up by $500 for her profit and then sell it for $5,000. Sounds like a pretty good plan. It's like a different stream of revenue for her. She meets John Stevens and realizes that John wants to buy the course but doesn't have enough cash available. And that's probably going to be a normal situation. So she's considering what would happen if she extends credit. And then she's considering what would happen if she accepts credit cards. Now, that's two different things. Extending credit is not the same thing as accepting a credit card. Extending credit means that somebody owes me. If I accept a credit card, I get paid right away by the credit card company. So the first two questions are about accepting credit, not about taking a credit card. So first two are about accepting credit. Basically, I'm going to provide the product and then I won't be paid for a certain amount of time. That means somebody's going to owe me. So let's look at the template. All right, so the template, I put part 1 and part 2 together. And that's the first two questions, part 1 and part 2, are about accepting credit. So make sure that you're not talking about credit cards here, but you're talking about accepting credit. They ask about the disadvantages and advantages of accepting credit, and then I think they say what are the precautions we need to take if we do accept credit. So that's part 1 and 2 for you right in here. Be specific, spelling and grammar count. Make sure your explanation is clear and organized. Then the template has part 3, 4, and 5 together. So we have a section for part 3, 4, and 5. 3 and 4 are about accepting credit, and then 5 is about accepting a credit card. If Kate decides to sell to John on credit, she's going to use the terms 210 net 30, which from your reading you know that 210 net 30 means that John will have to pay her in 30 days. However, if he pays her fast, meaning if he pays her within 10 days, she's going to give him a 2% discount. In part 3, what are the journal entries that she would do if John pays her within 10 days? In part 4, then what if John pays her within 30 days but after the 10-day early payment period? Then 5 has to do with accepting credit cards. So then they want you to do the journal entry if Kate decides to accept credit cards from customers. So 3 would be, first of all, the journal entry if John pays her within 10 days and gets a discount. Part 4 is if John pays her after the discount period. And part 5, this would be to show what kind of journal entries would be used if she accepts credit cards. Okay, now we're moving on to chapter 9. So in chapter 9, Kate has to buy some additional resources. She needs both memory and a new hard drive for her current computer, and she's going to buy a separate backup system. So the upgrades to her computer will be $420. The backup system will be a different asset. It's going to be $3,000. So first of all, it says the additional upgrade will not change the useful life for her current computer, but the backup system is going to have which is a different asset, is going to have a 5-year useful life. So first of all, just focusing on the $420, how will this be recorded? What's going to be the journal entry for that? So do the journal entry and explain how you're going to approach this. What they're trying to ask here is whether or not this should be an expense or capitalized. If it's an expense, it's just expensed right away. It's a one-time transaction. If it's capitalized, that means you're going to depreciate it over its useful life. That does have a lot of impact on the business's profit, so we need to understand that. So just looking at number 1, how should you do that? How should you do the journal entry. So for part 1, explain it and then put the journal entry that you would use. If you're going to capitalize it, that will result in one journal entry. If you're going to expense it, that's going to use an expense account instead of an asset account. And then you need to put the additional depreciation here. So, and what is this going to do? What effect will this have on her depreciation? So what do we mean by that? Well, the current computer has 42 months remaining for depreciation purposes. Here's the original cost. The current monthly depreciation is $100. So that's her current depreciation. Now you need to take the $420 and you need to say, well, if this is added into the system, how much is that going to impact it? So basically you're going to just take the additional amount, $420, divide it by the remaining useful life. The current computer has 42 months remaining, so divide it by 42, and that's going to give you a number, and that's going to be added to the $100. So that would be your new depreciation. So it'll be $100 plus the $420 depreciated over 42 months. Next, we're going to look at the $3,000 backup system. Kate would like to know how to deal with this. She's giving it a $500 salvage value, and she said earlier that it's going to have a 5-year useful life. So she wants to compare the straight line method to the double declining balance method. So I have another tab for part 3. So put the cost of the asset, the salvage value, the useful life. So that's all you got to do is put that there. Then for the straight line, put the amount of depreciation for the straight line method. I'll put that in here. So put the depreciation expense that you're going to have in each year, and then how did you calculate that? Now, as you recall, depreciation, if it's under the straight line method, will be the same amount every period, every year. The other option is the declining balance method. So the double declining balance method gives you more depreciation in the early years, so the depreciation expense is going to be higher in the early years and lower in the end. First, you need to get the rate. So put the rate here, and then how did you calculate that rate? Then you put the beginning of the year book value. So the book value at the beginning of the year, in year 1, I'll give you this, is $3,000. That's the first year. But then book value takes that amount and subtracts the accumulated depreciation from it. The first year you have a depreciation expense based on double declining balance method. Put that amount here. So that's based on taking the book value times the rate. So what amount is it here times the rate? So then that will be the depreciation expense. And then accumulated depreciation is how much depreciation has accumulated since the beginning. So each month there's a certain amount of depreciation. All of that added up is what gives you the accumulated depreciation. The book value takes the $3,000 and then subtracts whatever has been accumulated in the previous period. So I'll just put some numbers here. Let's say this is $500. It's not, but let's say it is. Your accumulated depreciation then is $500 because that's all that's depreciated. And then your book value is going to be the $3,000 minus the accumulated, so that's $2,500. Let's say the next year depreciation is $400. It's not. That's just an example. That means your accumulated depreciation is $900, and then that means your beginning of the year book value is $3,000 minus $900, or $2,100. And then you just do that all the way down. Now, you may not have depreciation every year. The book value will have to end at the salvage value, and you can never make the depreciation go so high that your book value gets below the $500 salvage value. Make sure you provide your depreciation expense calculation to show me. Remember, you have to show me your calculations or use Excel formulas. If you don't do one or the other, you do not get full credit.